give you an overview of the new menu.
Let me bring this up.
There was one handout. I hope you saw that, the investment options. So is this, do I have to change anything on there for this?
Nope, you're good.
Okay. And there's a sign-in sheet too, so I hope the throngs of you here have filled it out. Please wait in line, no pushing, please. Okay, so we'll cover the 3 different levels now that are in the plan, when the transfer occurred, how it happened, the new investments, a little overview of them, giving a little quiz, and finally your questions on the plan. So this all occurred in early October. We did the switch over. So the rest of that is gobbledygook. Other than we had that stable value fund before, we still have it. It's just called the Capital Preservation Fund. So it's a cash alternative fund. So this is, I think, the only slide on the target date funds. I'm assuming all of you are doing mix your own. Is that right? You're not a target date fund person, or you don't know? Are you? Okay. You think like, okay, good. Good place to learn them. So the target date funds are for the investor who doesn't know a whole lot. They're already mixed. Don't have to do a whole lot except figure out when you plan to retire. So there's 10 of them to choose from, and we recommend you only need 1 because they all have the same investments. You guys are all doing the mix your own, so I'm not going to beat this one to death. I'd like to move on. There are 2 slides, and there's the 10 target date funds. And when a person enrolls in the plan, I'm just going to say there's a quick enrollment we have, and we assume a default age of 65, but you can choose a different age if you want to. What's nice about these funds is you're not stuck in any one. If you decide to change, if your plans change, you're retiring earlier or later, you can always switch the fund you're in. So I always like people to understand that it's not, those years don't have anything to do with when you can take the money out. You have to quit or retire. You're just picking your current blend of investments. And then from that point forward, it's going to get more conservative. This is the second level. So the first level we have is the pre-mix funds. The second level are for those of you that may have been doing the mix your own. We had 15 different individual funds and went to 6 categories. And same sort of, we use this little dial for risk and return. So we have the capital preservation, which was the stable value fund in the past. So it's the least risk and lowest return of the 6 choices. Then there's a bond fund. So we start going up the scale. Now we're increasing our potential return and our risk. Real asset is a category designed to try and just keep pace with inflation. Then we have an S&P fund here. This mirrors the S&P 500, and I'll cover that in a little more detail. An international category, and then the small and mid-cap are now combined. So we used to have 2 small and 2 mid-cap funds. Now we just put it into one package for you. So of course, as you go further to the right, you increase your potential return and your risk. So the key is that, what sort of a blend should I have? And we'll actually do a little quiz in here that you can score yourself, and you'll see how you did. Here's how it changed. Again, this happened already, but if you were in, here's the mid-cap funds. How do I know? They say mid-cap in the name, mid-cap. And these were the small-cap funds. There were 4 of them. So if you had any shares in those, you automatically were moved or mapped, it's called mapping when we make a change, into that category. Likewise, if you had an international, it's now that category. Global disappeared. We don't have a global, because global means U.S. and international. So what we did is if you had any of the global fund, half of your shares went into what's now this category, the international, and half your shares went into the large cap fund. That gives you the global feel, because global means the whole globe, whereas international means everywhere but the U.S. Then we had 4 large cap funds. That's all now just that one category. We have this was our real asset fund, so we kept that category. Here's our income fund, we kept that category, and then finally there's that capital preservation. So there's actually 6 categories, 1, 2, 3, 4, 5, 6, now there's 6. Okay, what did I do wrong here? Small, mid cap, international. Oh, this one doesn't exist. Yeah, large cap, real, fixed, and capital. So there's 6 categories now. So here is what each of those categories consist of. And this, if you go to the Wyoming Retirement homepage, the Wyoming Retirement homepage, not the deferred comp. If you go to DC Information tab and you scroll down to the bottom, it'll actually show you the 6 categories, and you can click on the little blue link, and it will give you a fact fund sheet. It will describe to you it'll show you the investments that are comprised of that category. What we did is we actually have a company that monitors the investments, and we asked them to come up with the best combination of funds for us. The idea was we were trying to pick funds that complemented each other, that were diversified, that we were taking advantage of both passive and actively managed different management styles. So instead of you having to figure out if you wanted a managed fund or an index fund, we put one of each into each of these categories. So you're getting a low cost fund, because when they're passively managed, they're an index fund. That means the cost is low, but we also mixed it with an actively managed fund to try and gain a better return. So we're trying to complement management styles, and also the funds are diversified, so you're not getting duplicate investments as well. So it was to give you additional diversification, lower cost, simplify the process of picking things as well, yet still giving you a lot of stuff to choose from. I kind of equate it to this. If you went to the baker to order a chocolate cake, you wouldn't tell the baker what cocoa to use or how many eggs or how much sugar, but you get the cake. That's kind of what we had this company, the company that we hired to do this. We said, give us the best cake possible. You pick the ingredients. And that's what is going in. They pick these funds, and they pick that percentage for each of them based on their past performance. So you cannot find these funds are not traded anywhere publicly. That fund is not. That's exclusive to the plan. But those funds, the Diamond and the T-Row, those are publicly traded. So you can look and find information on those funds. But this combination of funds only exists in the Wyoming Retirement System. So these two here are actively managed funds, whereas that's an index fund. So that's where we're getting the low cost, but also a management team trying to beat the market. So now you now have 3 funds in that one category. That index fund is mimicking the Russell 2500, which is a small mid-cap index fund. So that's mimicking what it has. The cost, 0.58. I don't know how much you guys know about cost. 0.5% is nice. I try to get mine at that rate, but I can't always find it. If a fund makes 10 or 12% a year, they can charge me 1%. I don't care. I'll pay that. These are pretty good. These aren't bad. I mean, you can find some lower, and you'll find a lot more that are higher. So that was one of the advantages we got, is because you consider a big institution, we were able to get the funds at some lower cost, because it's indicated by those Y and I. Those are usually institutional shares, so it's a lower expense ratio. So that's a good thing for you guys, because that means those companies are they're giving it to us at wholesale, basically, instead of retail. So it's a good thing for you guys. So that's how we try to keep the cost down. There is the international fund. That now consists of 4 different funds. And what happens, by the way, is every day at the end of trading, BlackRock will look at how the ratios look, these percentages, and they automatically will readjust them every day. So let's say if the Dodge & Cox International stock did really well, and now it's at 12% of the total value, they'll just sell that 2% and then rebalance it to the other funds. So you're always going to have that balance. And again, that was decided based on the performance of those funds and how they complement each other to get the best flavor, the best cake we can get. Fee is a little higher, but it usually is when you talk about international funds. Most international funds are usually at well over 1%. So you're getting 4 funds for under 3/4. Pretty good deal. There's the large cap fund. Right now, it's just one fund. It's the BlackRock equity. That's an S&P 500 index fund. So it's going to mimic the S&P 500. That's a great, very doggone low. I mean, anything that's like 0.1. The only company is even close to being lower than that would be Vanguard. That's about the lowest mutual fund company out there. So these fees are very comparable to this fee is comparable to theirs. Here's the real asset fund. Notice this one's got 5 different categories in it. So it's got natural resources in it, precious metals, It's got some income funds, because that's what a real asset fund is, a conglomeration of multiple categories trying to get a return equal to or slightly better than inflation. So you've got both bonds in here, along with natural resources, infrastructure. So a lot of different categories are in here. Again, a blend of 5 different funds, and this is rebalanced for you every day. At the end of the day, you'll always maintain that balance, because that's what they found, that company found that's the optimum blend to get the best results. There's the fixed income fund. So that's like that bond fund. So in the past, we only had the one fund, and that was the Dodge and Cox fund. So we did keep a couple of the funds we had in the past. This is one of them. But now, instead of just having Dodge and Cox, you actually got 2 other funds going with it. So you've got some government and corporate bonds and some guaranteed insurance contracts, all trying, I'm sorry, that's in the other one, the capital preservation. So you got corporate and U.S. government bonds all in one category. So you've got safety in some in the government bonds, but a little more higher growth with the corporate bonds. And there's the capital preservation, which is the same thing as the stable value fund. Nothing changed at all in it. I think that's the last one. Okay, so here is, for those of you that are doing the mix your own, here's a quick 4-question quiz that I'd like you to write down your answers. I'll read off the questions. You want to score yourself from 1 to 5, with 1 being you disagree strongly, 5 being you agree. So I'll read each question for you, and then go ahead and write down the number you would score yourself, and then we'll add those up, and we'll see how you do on the next quiz, on the results, what kind of investor you are. Okay, question 1. I'm a knowledgeable investor who understands the trade-off between risk and return. I am willing to accept a greater degree of risk for potentially higher returns. 1, strongly disagree, to 5, strongly agree. So go ahead and write down what number you think you most closely associate with. And the winner is? Okay. Question 2, everybody okay? Easy questions. I am willing, number 2, I'm willing to invest on a long-term basis. So again, 1, strongly disagree, 5, strongly agree. Number 3, if one of my investments drops 20% in value over 6 months due to stock market fluctuations, and that's possible when we start doing our own investing, I would hold onto that investment expecting it to recover its value. Do you strongly disagree or agree? And finally, what is the air velocity of a swallow? What, English or European? I have savings vehicles other than this plan that make me feel secure about my financial future. So go ahead and add up your points to your answers. All set. So let's see what our quasi Jeopardy quiz puts you at. So if you had 4 to 8 points, we're going to consider you a conservative investor. 4 to 19 is moderate. 15 to 20, hey, you're willing to go to Vegas, baby. That's where I'm at. I'm the gambler. I like, well, at least in stocks anyway. People say this, they compare stock investing to going to Vegas, and I say, you know what? No, when I go to Vegas, you either lose or you win. You got a pile of money or you got nothing. When you buy stocks, you still own those shares. They're changing value, but I still have something. So to me, it's a little bit different. It's not as gambling, because the only way you can lose is if I sold it when it's down or the company goes bankrupt. So how did you got your scores, everybody? So here's what we came up with. If you were in that 4 to 8 point range, we're going to say you're a conservative investor. And here's what we're telling you is that you only want about 25% in stocks. So there's the large cap, the international, so large cap at 15%, some international at 5%, and the small and mid cap at another 5%. And then the rest broken between capital preservation and real assets. So this is just a sample to maybe guide you along the way. If you were maybe near the higher range of that, maybe 8 points to 9, 10, maybe you're more moderate risk. So what happens is now instead of 25% in stocks, we're going to jump it up to about 34% in different stock investments, and the remaining in the other categories. Again, this is just a sample because you can adjust for your level of comfort. And I'm pausing because I see someone writing some notes, so I don't want to rush you. Pens down? Oh, good. Oh, no. Still writing. And then here's the moderately aggressive. So now we went, what, 25% stock, 43 for moderately or conservative to moderate. Now moderately aggressive is at, I think 56% is gone to stock. So you see we're starting to increase the percentage we hold in those stock categories. So that's going to be the large cap fund, the international, and the small and mid cap. Those are the three stock categories we have. And then if you were at the top range of that score, that 20-point range, then you're looking at 70% in stock, with the remaining split between the bonds and real asset category. So this is just to kind of guide you. We're not saying this is a recommendation, this is perfect for you. It's a way to view to maybe see, is this where you should be at? And you know, when you get your statements from Great West, it shows you a pie chart. It breaks it down like this. So you can kind of use that to see if this is close to what is comfortable for you. I'm going to also tell you, there's a gazillion risk tolerance quizzes out there. Every mutual fund company's got one, and it's good to do a couple different ones because they might ask some different questions. We used a very simplified one here, but we wanted to just provide you with something to give you a little more guidance in your investing. We don't want to just leave you out there to flounder. Our job is to help educate you, so we're trying to give you a few more tools. Finally, the third level, this is brand new to the deferred comp. This is for you, for those of you that are slam bam, really sharp investors, and you're willing to walk the plank. You're on your own. I'm not saying walk the plank in a bad way. You want to go off the reservation. You actually could open a self-directed brokerage account. You actually have to go in your deferred comp account. It's under, I think, under investments. You have to actually expand that box, and you would open a self-directed brokerage account with TD Ameritrade. So you still have a 457 plan, but you're scooting over some money into TD Ameritrade, and you can then choose from, I think they've got 1,500 different mutual funds for you to choose from. That is for somebody who knows what they want to maybe get into gold, like specialty funds, because you'll be able to find those if you're into healthcare or precious metals, but you're going to have a whole lot more to choose from. But that means you know what you're doing. We're going to let you fly the plane. You can fuel the plane. You can navigate it. You're all on your own. Now, there is going to be an extra fee. It's, I think it's $50 a year to have that account. That's charged by Great West. And you need to look at the funds that Ameritrade's offering you because some of them are loaded funds. Load means there's a fee. So you might encounter the fees. But it's for those of you that want more than we have to offer. And there are some of you out there that want to get into things. No, there's no stocks because we didn't want to take a risk. Stocks are much more risky, and unless you really know what you're doing, we don't want to be held accountable for you having lost your account value. You didn't tell me it was risky. So anyway, so that's the deferred comp, the new levels in that plan. On the self-directed brokerage account, just the rules. You have to keep 2,500 though in the base, the 457 plan. So you have to have at least 2,500 already in there because you have to then shift money over to TD Ameritrade into the money market. And then once it's in their money market, then you can start buying whatever fund you've chosen for them. But you have to always keep the 2,500 though in your basic 457 plan. So if you only have 2,500, you can't open it yet. You'll have to wait till you get to like 3,000. So you can start to move over $100 or something into the self-directed brokerage account. So you've always got to keep at least 2,500 in the basic 457 plan, which means you're either going to have one of our life path funds or one of the mix your own. But if you have 100,000 in your 457 plan, you can move all over except 2,500 into TD Ameritrade if you want to go that route. Okay? That's it. That's the investment menu. Thank God, that's like the shortest thing I've said today. Even when I see my wife, my hellos take longer than that. So,
Are there questions?
any questions? Yes. Did that make sense?
Very helpful, yeah.
Good. Good, good, good. And the reason you're gonna get your statements soon, quarterly statement should be coming out from Great West. I don't know, this is January 31st return, so you can see what they're doing. I don't know if as of a couple of days ago, Great West still only had January 31st. I didn't see anything more recent. So, in your statement, they always give you one of these, the most recent one. So you can see how funds are doing. And of course, we've had a pretty doggone good first quarter in the market. Yeah.